We'll be looking at where home loan rates are headed and what you can be doing to prepare yourself and ensure that you have the best mortgage deal. How high do you think they could go? Because, I mean, obviously they talk about this normal setting of rates. What's that?
Well,
I mean,
if we look at what the current interest rate forecasts are for 1, 2 and 3 year terms, this actual rate rise has already been factored in. So the 0.25% that just went up has already been factored in. That was up till, say, the 1 year term. 2 and 3 year terms is pretty much what they're trying to predict at the moment. So if they're talking up to 3 year terms, the forecasts are there's probably one more percentage, a whole percentage point, up to about 3 to 5 years to sort of go up from where we are today. That's if you're looking at fixed rates. So fixed rates are generally a good sort of measurement tool to what variable rates will do. In saying that, though, some of the lenders are sort of profiteering in regards to saying, look, if you want peace of mind, and if you want that peace of mind that bad, you're prepared to pay for it, you'll pay a little bit extra to lock that rate in. The current 1 year fixed rates are pretty much hovering where the variable rate is at the moment, so that tells us that theoretically that the rate will hover around this sort of mark for the next 12 months or so.
We've had an email come in, and this one is from Greg. And Greg writes, just watching your show, wondering whether you think interest rates will go much higher in the next 12 months. So is it a good time to fix my variable rate? What's your advice for Greg, Robert? I know you were just mentioning there about fixed rates. For some people it is a way for them to reduce risk. But I mean, what's your view for Greg?
Well, for Greg, the current variable rate with the major banks at the moment is sitting somewhere plus or minus about 20 odd basis points, about 6%. Now, it's still possible to achieve rates at about 5.5 or thereabouts for a 12-month term. So in saying that, there is a way there where you can actually save some dollars by fixing in for that particular period. But when you do that, with some lenders, you actually lose some of the flexibility of unlimited repayments or unlimited redraw. So the ideal scenario is look for a product that gives you peace of mind of a fixed rate, hopefully lower than what you're paying now, but also make sure it gives you the peace of mind of making unlimited repayments and still having unlimited redraw. There are products like that in the marketplace. The banks won't publicly offer them to you because obviously it's not in their best interest to do so, but we have got access to products like that, so they do exist.
Great to have you on the program, David.
Oh, thanks very much. I've got a question for Robert from Australian Mortgage Options. I'm thinking about getting back into the property market again, doing some investments, and I was just wondering, on Robert's opinion, where does he see the interest rates going in the next 12 months, and what would be AMO's opinion maybe on the market in 12 months' time? Because I'm not too sure, but I'm thinking maybe even starting to fix, or just not too sure. So I'd like maybe a little bit of advice from Robert.
Yeah. Okay, Dave. Well, David, tomorrow the Reserve Bank's meeting and all the forecasts are telling us that there should be a substantial reduction, at least in the near future anyway, of at least 1 to probably 1.5% in the short to medium term. From AMO's point of view, we're currently banking on that and really putting our money where our mouth is. So we're even today offering people rates of up to 12 months. So if you're considering, you talked about fixing, you probably wouldn't fix any more than a year. And in this current economic climate, you can achieve rates sub 5% for a 12-month period. So what you'd probably consider doing is, if you are going to lock in, you want that peace of mind, don't lock in for any more than a year. And in doing that, what you'll probably find is that after that 1 year, so for example, we could get you rates at around 4.98 or about 4.99 now for a year, and then our forecast is that in 12 months or so time, you find that the standard variable, which now sits, depending which lender we go to, somewhere around 6.5 to 7, that'll probably come down to having a 4 in front of it in about 12 to 18 months' time. So if you are thinking of locking in, no more than a year, and you might be able to benefit of, because if you're looking to take out the loan today, the majority of your interest is calculated when the loan is the highest. So if you can get stuck into it and look at paying a bit extra today if you can, keeping your borrowing costs down, and getting it for about 4%, you're 4.98 or thereabouts, you'll find that depending where you're investing, that would almost be positive cash flow day one with an average return of, say, 5.5%, in some areas up to 6.5% today. So that's something for you to consider.
We've got some more callers on the line. Peter from Wilmot as well. Peter, what's your question for John and Robert?
Hi, I was wanting to ask the panel, with the major banks decreasing their interest rates to about 5%, why are some non-bank lenders still charging 7.5%? And secondly, are the major outer suburbs good areas to invest in where the median house prices are lower than the averages you just showed on your program, where the outer suburbs of the major cities are about $300,000 and the median in the larger cities is approximately $500,000? Is it now a good time to invest in the outer suburbs,
Okay,
where
well,
the median prices are approximately $200,000 lower than the median house prices in the major cities?
yeah, two good questions there. Perhaps, Robert, if you want to answer the first part of that for our caller, for Peter.
Okay, Peter, what you'll probably find is that some of the lenders out there in the marketplace that were doing some of those low doc loans, so to speak, their funding costs of recent times have actually gone up instead of coming down, because the people that ultimately end up funding a lot of those low doc loans or non-conforming loans as they also are known, the appetite for that type of investment is not as great as what it used to be. So you'll find that those particular lenders that are funding those low doc style loans have got higher on costs at the moment, because they're getting it out. They used to be able to get out at close to the same rate as what the standard variable rate was at one particular point in time. But as the market has moved down, and with some of the losses that they've received on that segment of the marketplace, they're actually trying to recoup some of those losses and not pass on those particular reductions.